So what should you be discussing with your CPA? Hopefully you've done like many clients, and because of all these tax law changes, you filed an extension. You paid your, or you're going to file an extension and pay your estimated tax. But even the CPAs are getting up to speed on this. The IRS is still issuing regulations on the law changes. So even the best CPAs need time to evaluate, understand, and implement them for their individual clients. Well, one of the first ones is SALT. How many of you are already familiar with SALT? Only a few of you. All right, so the state and local income tax, the most basic example is example 1 that you can see on the screen. Let's say clients are paying over $10,000 a year in property taxes. Too bad, you can only deduct $10,000. Well, that's a shock for people who are paying a lot more than $10,000. Who does it affect? Not only those where their homes warrant it, but if they have vacation residences that they've been deducting the property taxes for, or if they have residential rental properties, or as you can see there, oftentimes clients will co-own a property with a family member, and one of them is taking the deductions. Well, now you have to look and see who is allowed to take them with that kind of a limit. A second example that you may not be as familiar with is that this restriction of $10,000 affects irrevocable. So that's the item, if you're filling in the blank, it affects irrevocable trusts. Very important. It means either a trust has become irrevocable because someone died, or it's one of the trusts that we set up for children and grandchildren. So that it's an irrevocable trust for a family member, and that trust also has this kind of a limit. So what should the trustee do? Well, maybe we need to consider, like it says on the slide, maybe we move it out of California, because we have to look and see, as you'll see there, what's the source of income? Are they California assets generating the income? Then we're stuck. But if it's a portfolio or a rental property out of California, or a commercial property, or any other asset that's not tied to California, and if the beneficiaries, let's say the adult children for example, asset that's not tied to California, and if the beneficiaries, let's say the adult children for example, if they're not in California, then if we have the trustee, which we would change at that point, if the trustee, the children or beneficiaries, and the assets are outside of California, let's get out of California, because maybe the state they're in has a much better situation for tax deductions than California. So this is something that does have to be reviewed case by case.